A Bala joins us now. It represents Birla Sun Life AMC. Bala, fantastic to have you back. Thank you for joining us. Bala, we are living in interesting times. Domestic investors have become Robin Hood traders. Central banks have started buying gold, and as of now, there is a situation where earnings are just about okay, and markets they continue to rise.
Yes, Nikunj, morning. Thanks for having me part of the show today morning. I think the observation that you're making is of course an outcome of what central bank has done in the last 4 or 5 months, which we have been of course saying it for quite some time, that worldwide the central banks have acted very aggressively to boost the confidence by way of cutting rates, by way of bringing in more liquidity, by way of providing greater support to every corporate in the world, therefore pushing down the interest rates to such a low level, then naturally it makes everyone to think about what are the alternates that one has to find. The reason why we are seeing that some of these gold, and even that there has been a significant rally in the bond market, I think all of them have come on the back of the central bank great work that they have done in the last 4 or 5 months in injecting the liquidity in the system. But having said that, this problem is of course not just is that exist only in India. Even the global market is seeing a similar kind of scenario. The reason why we are saying there is an increased level of traction towards the risky asset class, especially an equity which comes in, of course, the risky asset class. And the gold, of course, is actually the hedge against dollar. And that's where I think the money has been moving up. And lastly, of course, is led by the inflation. There has been except India, where we have seen some bit of spike in the inflation, mainly because of the food inflation going up. I think globally, inflation remains very much under control, and therefore leaving very little money to be made in the form of real interest rate being available. And therefore, we are seeing actually there is a good amount of traction towards the even gold as well. I think this is a worldwide phenomenon. And there's one thing that we have seen, Nikunj, is we did some kind of analysis. The 2008 post-crisis, it took almost about 1.5 years to provide the necessary support to revive the economic growth. Whereas in the last 4 months post-COVID, the support that has come from central banks and the respective governments is so sharp. Whatever they could do actually in the 1.5 to 2 years in the previous period, the crisis time, this time they're done in a matter of about 4 months. So it takes some time actually for such a sharp support that has come for it to reflect. That's why I think we have seen a sharp bounce back in the market was largely on the back of that. I think we are at a stage where a bit in a tricky situation that earnings versus market, there is a gap, reality gap. Therefore, how that has to get adjusted is something one has to just watch out.
Bala, last 2-3 months have been tough for the mutual fund industry, especially on the equity side. Are things finally looking up in the month of August, or August is also shaky?
I think the way I see the trend, Nikunj, last 1 year, if you see 2019, we saw actually a declining net sales numbers that continued. I think April, May, June, I think we probably went into the negative bit for the industry. I think the rate of redemptions for the month of August has come down, I would say. I think probably we would have seen July was the worst in terms of net sales being negative for the industry and equity. I would probably assume the month of August, the way it's begun, that would be a downtrending trend. At the same time, even investors' point of view also are in a perplexed. They're also a little perplexed that why I have my investment, but the equity market is showing some kind of bullishness. At the same time, returns take some time to come back. Whatever the people have been redeeming, they're also now introspecting. Actually, am I taking the right call, not taking the right call? So therefore, that kind of assumption is coming in the mind of investors and distributors, as well as the way I think we also been projecting the outlook. Probably we'll see the trend going down, and probably will turn into positive as the market corrects. So one thing which remains still, not just only in India, even globally, everyone who's been sitting on the sideline, not expecting such a sharp bounce back in the equity market, everyone wants to actually invest on correction. And hopefully when the correction comes, we will probably see the reversal of flows into the mutual fund industry in India.
Okay. Bala, we've discussed this several times, but given the nature of the market and the little bit of rotation that we're seeing, the continued up move that you're anticipating, would you change the weightage in the portfolio at all in terms of the kind of themes that you're looking at or the ones that are likely to be more pronounced going forward?
Yeah, I think some of the areas where we have been quite successful in building our portfolio post to COVID when the fall came, which is linked to the economic downturn, and also the growth is not going to come back in a hurry, then where do you hide yourself in such a scenario in portfolio allocations? Clearly, we have been quite successful in building the portfolio towards sectors that we can call it as a little bit agnostic to the current downtrend, pandemic-related issues. At the same time, there could be beneficiaries such as pharma, such as IT, even such as energy sectors. And that's why I think we went a little overweight and at the cost of bringing down the exposure to the financial service sectors to some extent. At the same time, we're also seeing some of revival of sectors, especially on rural-related demand that could come back on the back of good monsoon. And also these sectors such as commodities, which is of course cyclical sectors, but having seen a significant fall, having seen destruction of value in commodities in the last 4 or 5 months, now this demand supply equilibrium coming at par and start seeing actually the uptick on the price movement. There also is something which as a fund house have done in terms of allocation to the metal as a sector, commodity sectors. So I think these factors helping us definitely in the portfolio constructions. But having said that, as I mentioned earlier, the market uptick and buoyancy vis-a-vis the buoyancy and economic growth, there is a gap. At the same time, there is a gap between the reality versus the earnings outcome expectations. That's something I think one has to live with that, given the fact that one has to do a right balancing between the growth versus value and the liquidity versus where the interest rates are prevailing and so on and so forth.
All right. Okay, so that's the kind of intention there as well. In terms of the risk factor currently, Bala, do you feel that perhaps, as we've been discussing, a lot of the optimism is priced in? Is there an element of risk that's still associated, or now it's pretty much just waiting for that uptick to play out?
So I think the uptick to play up now, having now seen a significant uptick in the market, naturally it has to get the sufficient support coming from the earnings as well. That's one. The one area where there is significant support is coming with related to the interest rate transmission. I mean, if you look at the last 4 or 5 years, India has been struggling to pass on the transmission of interest rates, reduction of interest rates coming from the central bank to the ultimate borrower. I think government has done a great job in this area of providing the comfort to the banks for extending loans to the MSMEs and SMEs by way of guarantee. In fact, probably the banking industry will show an uptick on the credit growth only because of the government, the support that has come for the SME sectors in the form of credit growth picking up, which comes up, of course, about 9.5% with 100% credit loss, which is more like a sovereign credit that you take. And also still get about 3-4% kind of margin over lending to the government of India directly or state governments directly. And that's something in my view has helped in bringing down the interest rates. And even the home loan rates, if you see today, has now dropped about close to about 7.25% for the middle class borrower, which also means that there has been a significant success which the Reserve Bank of India has created in transmission of rates to happen in reality. This, in my view, will take some time, and that's one of the reasons why there is a hope that it still remains that consumer demand could come back, especially on the borrowing side, is largely coming from the fact the interest rates are so low, liquidity is so high. At the end of the day, carry game will come and hit the most of the banking industries. The more the liquidity keep the money in Reserve Bank of India window at say 3.35%, then actually is going to hurt your interest margin and therefore your profitability. Therefore, every banking sector players have to come back on the lending side. And that's something in my view the government is pushing very aggressively. Initially by way of guaranteeing, But as time progresses, as things get better, probably the banks will start laying on their own, and therefore the credit market, I think, will start picking up. That's something which still remains some bit of concern for the growth to come back in a hurry. But having said that, and my view is RBI has achieved a big, greater purpose of bringing the interest rates along with the government of India in the form of guarantee schemes, which in my view, I think gives a lot of scope and hope for the revival of the consumer demand to come back. May not be in the next 1 or 2 months, but I think the sustained low interest rate regime will force the lenders to go to the market for looking for borrower, and that's the time actually they will see the confidence get better.
Bala, I want to go back to the basic positioning what banks currently are there with mutual funds. I know you've said that why banks the medium term outlook is better, but don't you think there is a technical overhang? Most of the funds are overweight financials, A, which are underperforming, B, financials have been on a binge to raise capital. So you do have a situation where an underperforming sector has raised a lot of capital. And that in a sense is going to make sure that for next 6, 8 months, 12 months, the appetite from the institutional investors will not be there. The other categories, traders and momentum watchers, who will also not buy a bank because they are underperforming. So when do you think banking stocks will start moving higher? Because there is a technical overhang, there is an economy overhang, and there is an NPA concern.
I think interesting, Nikunj, we're just doing some kind of analysis with respect to the profit contribution to the Nifty versus the market cap contribution. Then naturally, as I mentioned earlier, the profit contribution coming from the banking sector, which owns about 33% of the index, right, or 33 or 34%, is only about 22%. So that, of course, dropped significantly. Then naturally, you also see the market cap of these companies, especially in the last 1, 2, 3 years, got destroyed. Purely on the base of the profit contribution is not up to the same expectation as increase in market cap. Therefore, the market got corrected as a result of that. But having said that, I think banking sector is a proxy to the economy. Then naturally, when we see actually the economic growth to be negative, the banking and financial sectors will tend to underperform, no doubt. At the same time, when we see actually the uptick that could come, as you start seeing the economic growth coming back, the lead indicator would come purely on the basis of the credit growth. And that's one lead indicator. As the interest rate gets stabilized, and then we know actually that one will start getting some bit of higher income on their investment, and that's how another lead indicator will come. I think these two put together, and also reduction in the NPAs, I think that's the third lead indicator. These things, I think, once you start establishing the proper trend, the banking stocks, I think, will start outperforming. And given the fact that most of the banks today have raised equity capital close to their book value, maybe about 1.3 book value, which is relatively cheap, and therefore immediate outperformance expectation from the sector is going to be really difficult, given the fact what I just mentioned about some of the lead indicators are not showing an uptick. As the lead indicators start showing an uptick, maybe the next 6 months, we'll see the banking sectors to start to perform better. But having seen that, one of the reasons why the overweight on the banking sector, the neutral weight still remains, but one doesn't know actually when the V-shaped recovery will come. As the lockdown gets lifted, when the consumer spending starts coming back, supported by the good monsoon-led growth coming from rural economy, one doesn't know. It's extremely difficult to predict whether we will see a V-shaped recovery. If it comes, when it will come, whether it will come end of the year or maybe the beginning of next year. Therefore, very difficult actually to time the market. Therefore, most of the people prefer to keep an equal weight to the sectors, given the fact it's the large sectors, and second, it is a proxy to the economy. That's the way I think everyone is sitting on the sector. Though it's underperformed the index quite substantially, the reason still remains only because of that.
Sure. Bala, theoretically, the movement in gold prices as well as silver, in fact, the entire precious metal cluster, also, do you think poses to be a challenge for the case of equity investment right now? Because obviously, when you're asset allocating, your allocation to gold right now would be much higher than equities, perhaps.
Yeah, I think interesting on this. I think clearly equity is seeing a lot of traction only because of the risky assets and they're available at reasonably good prices after the prices crashed. And therefore, everyone actually keen in putting money in equity and gold only because of the two reasons. One, of course, real rate of interest is low globally. And second is gold provides hedging against dollar. And that's why I think the money is moving towards gold and some on silver. Silver, of course, is also on the back of some economic recovery. If it comes back, the PMI number, if you see, except India, China, and most of the economies, the PMI numbers have been coming better, which means that their economic recovery in some of the emerging market global economies on the card. Therefore, silver, other industrial metals will pick up. That's why we have seen stability coming on copper, stability coming on zinc, iron ore prices have been rising, and steel prices are quite stable. All these things are indicating towards that one can expect some bit of demand to come back on these materials. So that's one of the reasons why we are seeing movement towards equity, which is nothing but risky assets, and the movement towards gold. Having said that, any bond market, even if we take today, let us take assuming scenario in the US is put in 10-year bond is close about 0.5%, and the risk that you are running on 0.5% if the yield goes to say 0.6 or 0.7 is equally high as you are running actually in the case of equity. That's why I think most of the global investors, given the fact the interest rates are so low, and in fact they have to generate 7 to 7.5% in case of pension funds as a return to the investors, they think actually the best way to invest through that methodology. Second interesting that we've done, which you have seen, of course, in India's case, the dividend distribution tax is actually hurting most of the companies not to declare more of dividend. Otherwise, the distribution tax had not been there. Most of the companies in India would have given a higher dividend payouts to the shareholders, which would actually increase the dividend yield in the portfolio, and therefore the greater participation would have come for some of these companies. And that we are seeing actually in the global economy that most of the companies are also being tracked in traction. Are those companies who have also got reasonably good dividend yield and carries a higher value purely on the basis of the replacement cost theory.
Bala, great to have you on the show as always, and thanks for sharing with us your thoughts on the markets.